Today on the Purpose-Based Retirement, we'll be discussing your required rate of return during retirement, filing for Social Security early, and Yale Professor of Finance introducing a new asset class to improve your returns and lower your risk.
Welcome to the Purpose-Based Retirement with certified financial planner practitioner Casey Weade.
It's not how much we make during the good times, it's how much we keep during those really bad times.
Casey leads a team of financial advisors with decades of experience, helping families across the country retire with the confidence they deserve. The Purpose-Based Retirement assigns every dollar you've saved a specific purpose to meet a key retirement need.
Whatever risk you faced, we've got a plan for that.
Stay tuned and learn how you can look forward to a worry-free, purpose-based retirement.
Good to see you again. My name is Lee Kelso. I am here with Casey Weade, certified financial planner and the president of Howard Bailey Financial. We're going to kick the program off today using a phrase that you use a lot in your industry, the hurdle rate. What do people need to know about that?
Yeah, we've used the hurdle rate a lot, but we've also called it our required rate of return. So rather than just looking for the highest rate of return we possibly can, which a lot of folks will walk in our office and say, we'll say, how much do you want to make every year? And well, it's kind of a joke, right? Well, they go, I want to make 10%, 20% a year, and the reality is the higher that rate of return that you want to get every year, the more and more risk you're going to have to take. So the first thing we want to start figuring out is what's your required rate of return. What do you need to see in the way of rate of return on your entire portfolio every year in order for your retirement to be a success?
So people are asking the wrong question. They're asking, how do we do against the market? But they really need to be focused on that hurdle rate.
I think it's okay if we want to talk about, beating the market rate of return when we're in our accumulation years. I had a couple the other day that they had a portfolio that they were trying to invest very aggressively. And when we analyzed that portfolio, what we actually found is their portfolio was averaging around 6% a year the last 10 years, when the market was averaging around 7.5%, 8% a year over that same period of time. And they were still losing as much of the market in the down years and making less than the market during the up years. That's a problem. They should have had that analyzed long ago to figure out what they were actually returning versus the market and what degree of risk they were taking, because the rate of return was subpar for that level of risk that they actually had in the portfolio. But the reality was, in their situation, they didn't need to have nearly as much risk as they actually did. They had a situation where they had about $3 million in real estate, they had about $1.5 million in investment dollars, and they had enough to last for the rest of their lives. 57 years old, 3 years out from retirement, they had enough to last for the rest of their lives, but they didn't realize it. And one of the questions I asked is, how much would you be comfortable with losing over the next 12 months? And most of the time I get people saying, I don't want to lose anything. However, in his situation, he said, well, $500,000 would be okay, because I guess I could work a couple more years if I wanted to or I needed to. And I said, but you don't need to. The reality was, if we look at $4 million, we make 3% a year on $4 million. It's $120,000 a year. That's more than they were spending year after year, and we haven't even included Social Security in that. Right. They only really needed maybe 2 or 3% a year in order to be successful. Why would you take that risk in your portfolio to lose $500,000, maybe have to go back to work for a couple of years, if you didn't have to take that risk? But he had never really looked at it that way, never really figured out what that hurdle rate was, what that required rate of return was. And after we did that, he goes, wow, the light bulb came on. Well, what was the light bulb? He goes, now I'm really not taking risk for myself, right? This risk isn't for my own benefit. This risk was for his children's benefit, because he was never going, if he doubled the level of his assets, he wasn't going to spend more money. People's spending habits are pretty well ingrained in them over the decades they've spent saving and working and accumulating, that we're not all of a sudden going to double our expenses just because we double our assets. But if those assets, take all the assets you have, cut them in half, you'll change your spending habits. And if nothing else, it's going to cause a heck of a lot more stress unnecessarily in a time in our lives when we shouldn't be worried about stress.
Yeah. So why not take a look at the Dow or the S&P 500 and use that as a benchmark for how things are going?
Well, I think that's really concerning to say, well, the S&P 5, what's the market doing? First of all, that's what most people say. This is the market. Well, the reality is the S&P 500, the Dow Jones Industrial Average is not the market, right? That's just one type of security in one sector of the market in one geography. We're talking about U.S. large cap stocks. In the case of the Dow, it's only 30 stocks. In the case of the S&P 500, it's 500 stocks, and you're just looking at U.S. equities. So if you are invested in a large cap blend portfolio, then maybe you should be using the S&P 500 or the Dow Jones Industrial Average as the benchmark that you're trying to beat year after year. I can tell you this, if the market's up 10%, if the S&P 500 is up 10%, you're up 10%. If the S&P 500 is down 10%, you're also going to be down 10%. You're going to be down 40% if it's up 40%. And now you're taking on a level of risk that you should have been taking on when you were 30 years old, 20 years old, you're 30, 40 years from retirement. But now if you're doing that same type of investing as you step into retirement or already in retirement, you are taking on the risk of running out of money during retirement. You don't have diversification. And we're going to talk about this in another show. If you had a portfolio of 60% fixed income, 40% stocks, you've got a balanced portfolio. I bet I can still show you how that portfolio would lose 30% in a bad market, because the assets during down times that are out there that are traded on the exchanges, like stocks and bonds, they start to act a lot like one another. They start to move in the same direction in those really bad times. And this is what we don't want to happen. This is why, endowment funds out there include alternative investments in order to make sure that they've got true diversification and they've always got some place they can go in the bad times.
So I've been trained my whole investing career to think about other benchmarks. How do you figure out what my personal hurdle rate is going to be?
Well, we've got to take a lot of different things into consideration. The first thing I like to do when you come in to visit with us is do it in a very simple manner, something that nobody's ever done with you, because typically you sit down with an advisor, they're just waiting to sell you the next best money manager, the next real estate investment trust, the next annuity, the next product, when it's really not about that. First thing that I want to do is say, okay, how much have we saved for retirement? Let's really dial in on what our expenses are. Let's figure out what our guaranteed income sources are. Maybe we've got Social Security, maybe you've got rental income, you've got farm income that's going to supplement your expenses in retirement, and now we figure out that gap. Let's say that we've got $3,000 a month in Social Security and maybe a little rent here and there, and then we have expenses that are $5,000 a month. So that's a $2,000 a month gap that we have to fill. That's $24,000 a year. Then we have to figure out how much we have saved for retirement. So if we have, say, $500,000 saved for retirement, we can plug that into our calculator, and what we can so often find is, well, we only need to make 5% a year in order to be a success during our retirement years. And then we start working backwards. Okay, so we only need to make 4%, 2%, 5% in order to be successful and preserve our principal. But what are those outliers that could potentially rip that dream out of our hands? Well, those outliers could be things like healthcare risk. So do we have a plan for some defense against major long-term care expenses? That's one of those curveballs that we need to put a plan together for. What about inflation? Do we want to put together a specific plan to play defense against inflation, or make sure we have a substantial enough emergency fund and have a tax strategy? Because if we think about a tax strategy, if we end up minimizing your taxes by, say, just a little bit, right, we might be able to lower that required rate of return by a little bit, and also lower the amount of degree of risk we have to take by a little bit as well.
That's a big mental adjustment for people, isn't it? I mean, you've been hard charging, go, 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 take that risk, earn as much as you can all through your career. Now you hit retirement and you have to shift your thinking.
Yeah. Harvard released a study not too long ago that was showing this is a challenge that the baby boomer generation is going to face that previous generations didn't have to worry about, because they typically had pensions as they stepped into retirement, or they had Social Security, and retirement didn't last nearly as long. And now these retirees are going to spend a lot longer period of time in retirement. They don't have pensions, and Social Security has a question mark behind it. And so now they have to rely on their own savings, and that means stopping to think about your money as not just a place to get growth, right? It's not return on my money anymore. Now let's shift that way of thinking to return of my money and making sure that it lasts a lifetime. And that's a major shift for financial advisors as well, because they've been working with baby boomers in their accumulation years. Now they have to figure out how to specialize in retirement planning.
Yeah, that is a big shift. It's a tough shift that a lot of people have to make, and lots of people need help, and we hope that's one of the reasons that you'll pick up the phone and call Howard Bailey Financial and be one of the next 10 people to call and inquire about a complimentary review of just what's going on. How can you make that shift? Are you well positioned for retirement? What kind of fees are you paying? Taxes? Is there an income plan? Do you have a health care plan in place? All those things are important. And the folks at Howard Bailey can help you get started down that path with a complimentary review of just what's going on in your portfolio. You can sit down with Casey or a member of the team and get yourself down the path toward a purpose-based retirement. So I hope you'll be one of the next 10 people to pick up the phone. All right, we're going to jump on the phones when we come back and answer your questions, so stay tuned.
You need a plan to create the retirement you deserve. The first step is to tune in to the Purpose-Based Retirement Radio Hour with Casey Weade and Marshal Johnson. Saturdays at 11 a.m. and Sundays at 1 p.m. on WOWO 107.5 FM or Sunday mornings at 11 on 95.3 MNC.
The highest educational achievement for a financial planner is the Certified Financial Planner certification. At Howard Bailey, all of our frontline advisors are CFP practitioners. Certified financial planners have been thoroughly vetted with the right education and experience to coach you through the complexities of your retirement. Getting to retirement, that's really the easy part. Find someone with what it takes to get you through this next stage of your life. Would your financial and retirement affairs benefit from a higher level of insight and care? Call us now to find out.
This is the part of the program where you set the agenda with your questions. We're going to get out to Jada in Fort Wayne to kick us off.
Do you recommend most people take Social Security early or delay it? It seems most advisors or experts recommend delaying it until 70, but that seems like entirely too long.
Well, Jada, that sounds like a great thing to do, is to delay that Social Security, but it's not a reality for most people. We can't wait that long to take Social Security because we need the income. The majority of people are still filing. About 50 to 55% of filers are still taking Social Security early at age 62. We're seeing that number come down, though. A lot more people used to file early than they do today. That's for a number of different reasons, though. They're not necessarily doing it out of strategy purposes. They might be working longer. We're seeing more people have bridges to retirement, continue to work. I say take it when you need it. If you're 62, you might be able to get more income out of Social Security if you wait till 70, but it's going to cost you along the way. Let's say, for instance, you're getting $12,000 a year from Social Security if you file at 62. Maybe you're getting $20,000 a year if you wait till age 70. But between the ages of 62 and 70, you've got 8 years. It's going to cost you about $100,000 to get that income from somewhere. And then by the time you're 80, you've broken even. Now you've collected about $200,000 from both sources, and then you start getting ahead by delaying those benefits. However, I want to make sure that you're protecting the dollars that you know you have, and maybe spending the dollars that we know that the Social Security Administration is a little short on.
So let's move from Social Security to pension now, and a question from Darren up in South Bend.
I'm looking at taking the single life instead of the joint life option on my pension because the difference is just too big to justify the hit, and we need the income. Is there any way for us to get our cake and eat it too?
Well, Darren, I don't know if there's a perfect scenario for this because you're going to give up something probably somewhere. I think what you might want to look at is something called a pension maximization strategy. It's something that you don't too often see utilized much these days, but if you want to learn more about that, you can go to the purposebasedretirement.com and pick up my 2018 guide to maximizing retirement efficiency. That's purposebasedretirement.com, and then I really lay out in there what a pension maximization strategy is, which is really what you're trying to accomplish here. You're trying to get income from that pension and get more income than you can get from the joint life pension. Think about it very carefully, what you're actually getting with the pension coming. Let's say that you're getting a pension benefit that's $40,000 a year for single life, but you're going to get $20,000 a year for a joint survivor benefit. Now, if you take the $40,000 benefit, you pass away tomorrow, nothing's left to your spouse. You take the $20,000 a year, she gets income, or he gets income for the rest of his or her life. You're really paying $20,000 a year premium, really for life insurance, income continuation insurance. So it might be worth you saying, well, what if I do that myself? What if I get private insurance to cover this gap? Let's say, for instance, that you want to pay, $100 a month. You might be able to pay $100 a month and get a 20-year term policy to take you from, say, age 60 to age 80, and that's $200,000 in death benefit, let's say. That's going to recreate about $10,000 a month in income. So maybe you want to double that. You spend $200 a month, and now you know that you're able to recreate about $20,000 a year in income, which is about what the pension would have provided, but you don't have to take as large of a haircut, and if something happens to both of you, it still passes on to your heirs. Where the pension, you both pass away tomorrow, it's gone. You might also pick up some long-term care benefits, being able to accelerate that death benefit and use it as an alternative long-term care coverage, and you get more flexibility. With a lot of pensions, you make that decision to get the single life pension, you're stuck with that for the rest of your life. Now you're going to maybe ladder different life insurance policies out so your premium decreases over time, you put more money in your pocket over time, you've got more spendable income over time, and you've got flexibilities to cancel those policies and put more money back in your pocket if that happens. Maybe the other spouse passes away before you do, for instance. So a lot of things to think about there, and wonderful question, Darren. Thank you.
And that life insurance benefit would be tax-free, right?
That's right. Yeah, it'd be tax-free versus the income that you're getting from the pension is taxable.
Yeah. All right, let's get up to Auburn and Carrie with your question.
We've always used mutual funds, but now our advisor is trying to shift more and more into individual stocks. It makes me uncomfortable as it feels like we're taking on a lot of risk that we can't afford at this age. When is it appropriate to own individual stocks instead of mutual funds?
Well, Carrie, we're seeing this more and more today as this transition away from mutual funds and into ETFs or into individual stocks, into individual bonds, because it used to be the only option. You'd walk into your advisor's office, say, hey, I have $500,000 or whatever it is to invest, and you would end up with a mutual fund. And that would get you professional management and diversification, but you had to accept some of the flaws. You had to accept a lack of transparency, higher fees and expenses, and really some pretty tax inefficient investment vehicles as well. Now today you have the ability to go out and hire a team of managers that will manage that account exclusively for you, and that's what needs to happen. If you're going to invest in individual stocks, that's fine. You just want to make sure it's not the guy down the road that's trading stocks in his free time. Even if it's your financial advisor, I'm not going to manage my own investments that are in individual stocks, or my clients for that matter. I want to make sure there's an investment management team that's looking at that every single day of the week and looking at those earnings reports, looking at the management of the company, and being ready for changes as they're made. If it's an advisor that's saying, hey, I'm going to manage your portfolio for you, and starts to buy individual stocks, and it's just him, or it's him and a couple individuals, that makes me a little uncomfortable, because I know they're still managing a team, they're managing other clients, and they're trying to create new clients. You want to make sure you're working with a third-party manager that's going to watch that portfolio every day of the week. And if you have concerns about risk at this stage in your game, maybe stocks, mutual funds, ETFs, maybe that's not the solution for you. Maybe we need to at least carve out a portion of this portfolio to give you some certainty regardless of what happens in the markets. So thanks for your question, Carrie.
Uncertainty in the markets, if that is keeping you up at night, I have an opportunity I hope you'll take advantage of. I hope you'll be one of the next 10 people to call Howard Bailey Financial and ask for a complimentary review of your entire retirement and financial plan to understand just how much risk is there in your portfolio, to stress test that portfolio and learn what's going on. We'll take a look at fees and expenses, taxes, Social Security planning. Do you have a plan for a long-term income you can't outlive? All things you need to pay attention to as you plan for retirement, and I hope you'll get some professional help to do that. Be one of the next 10 callers to call the number on your screen right now and set an appointment with Casey or a member of the Howard Bailey team, and take a good look at what's going on in your portfolio so you can make some really strong decisions for yourself and your family moving forward. All right, we are coming back in just a second with our question of the day. It has to do with the best performing asset class from 1927 to 2018. Which of these is correct? Casey's answer is coming up.
You need a plan to create the retirement you deserve. The first step is to tune in to the Purpose-Based Retirement Radio Hour with Casey Weade and Marshal Johnson. Saturdays at 11 a.m. and Sundays at 1 p.m. on WOWO 107.5 FM or Sunday mornings at 11 on 95.3 MNC.
The highest educational achievement for a financial planner is the Certified Financial Planner certification. At Howard Bailey, all of our frontline advisors are CFP practitioners. Certified financial planners have been thoroughly vetted with the right education and experience to coach you through the complexities of your retirement. Getting to retirement, that's really the easy part. Find someone with what it takes to get you through this next stage of your life. Would your financial and retirement affairs benefit from a higher level of insight and care? Call us now to find out.
Our question of the day put you to the test, testing your knowledge on asset classes. We asked, what is the best performing asset class from 1927 to 2018? Casey?
Well, it's probably pretty obvious, and it's probably something that you've heard before. It's large cap stocks. That would be option A. I'm going to share with you some research regarding stock and bond market history. There's been a lot of talk today about the bond market crashing, and we're going to share with you some research from Yale professor Roger Ibbotson that's going to maybe open your eyes to another way of thinking about allocating your overall portfolio, opposed to that traditional 60-40 method of stocks and bonds, or the balanced approach, if you will. If we look at the history of these different asset classes, we can see that large cap stocks have greatly outpaced the growth of long-term government bonds, U.S. Treasuries, and inflation, with long-term government bonds seeing about half of the level of risk or volatility and also about half of the annual rate of return of large cap stocks. U.S. Treasury bills being in number 3, just above the inflation rate of 2.9% from 1927 through 2016. Now let's take a look at these annualized return numbers of large cap stocks versus long-term government bonds. If we look over the last 90 years, the annual return of large cap stocks has been just over 10% a year with a risk level of 20%. If we look at the annualized return of long-term government bonds, annualizing 5.5% a year with about half the level of risk. But now it's really interesting if we pay attention to the bottom of your screen over the last 10 years. Over the last 10 years, we've seen large cap stocks return come down quite dramatically to about 7% a year, and we've seen long-term government bonds almost match that rate of return at about 6.5% per year. We're seeing about the same level of volatility and the same average rate of return. The reality is that these things usually revert back to a mean, and that means that this probably won't continue forever. Why is it happening? Well, let's look at historically the makeup of those returns of long-term government bonds. It has been the annual total return of 5.5%. But 5.2% of that has come in the form of income or coupon payments, very little in the way of capital gains or the increase in price of those bonds themselves. But if we look at what's happened the last 10 years, as interest rates have been falling, bond prices have been rising, and that annualized 6.5% rate of return, out of that 2.9%, almost 3%, almost 50% of the annualized rate of return in government bonds has been coming from price increase. As interest rates have been falling, bond prices have been increasing, and that may change directions in the future, presenting itself with a difficult place for the bond market moving forward. From 1981 through the end of 2016, interest rates have been continually falling, but it is a reversion to the mean. If we see interest rates rise, which we will at some point in the future, that may change things for that traditional 60-40 portfolio. And that is what Roger Ibbotson, professor of Yale School of Finance, shared with us here recently in a document he released, sharing with us how we could potentially incorporate a fixed indexed annuity in order to save us from the supposed bond bubble moving forward. If we look at his hypothetical returns of large cap stocks, government bonds, and fixed indexed annuities, we can see that annually from 1927 to 2016, we would have outperformed long-term government bonds with a fixed indexed annuity, and we would have done so with no downside risk. With the worst 3-year annualized return for equities down 27%, long-term government bonds down 2%, and fixed indexed annuities with no downside risk. If we chart that, as we did when we opened up the segment, we can see that if we incorporated the large cap fixed indexed annuity, we would find that that would greatly outpace the growth over the long term of a long-term government bond, but still not get us really anywhere near the annualized rate of return of large cap stocks. However, in retirement, what are we looking to do? We're looking to lower that level of volatility, lower that level of risk, and make sure our money lasts a lifetime. If we look at the variability in returns when it comes to large cap stocks, we can see that some of those returns go down 7%, down 7%. About 15% of the returns on an annual basis will land in that down 10% to 0% range, and about 30% of those returns land actually all the way up to 15 to 20%. If we look at long-term government bonds, only 13% of those returns land in that negative 0 to 15% range, while about 75% of them are landing between that 0 and 10% range. If we look at historical fixed indexed annuity returns, we see that about 77, almost 80% of returns land from 0 to 10%, and about 3% in that above 20% range. But the return variability to the downside is the important part, where we don't have any of that downside risk. So now we take a look at how we incorporate a fixed indexed annuity in our overall asset allocation. If we look at traditional 60-40 stock and bond returns of 7.6% in below average bond return environments. So if we have a bad bond market moving forward, we're looking at a 7.5% annual return with stocks and bonds. If we incorporated a fixed indexed annuity, we would see those returns increase to 8.1%. All the way up to 8.6% if we completely replaced those bonds. Now, if we see a good bond market moving forward, we would probably just slightly underperform if we start inputting a fixed indexed annuity into that overall plan. I think that most interestingly, overall, from 1927 to 2016, we always would have been better off incorporating a fixed indexed annuity into that overall plan. If we see a 3% rate increase over the next 3 years, if we have an equity environment that's down 10%, we're going to see that we're going to outperform in a down equity market by having that fixed indexed annuity as part of our portfolio. And to the upside, will actually outperform to the upside over incorporating bonds into that portfolio as well, actually taking that return from 10% all the way up to 15% by removing those bonds and using a fixed indexed annuity as part of the overall plan. Lee, maybe you want to take it back down to earth for us a little bit.
Yeah, so a fixed indexed annuity, watch me try to dance around this one. A fixed indexed annuity is a great way for me to get the gains and avoid the risk. But my question for you is, how do I find the right indexed annuity? Because there are so many complicated versions on the market.
You know, I think you have to incorporate a lot of different types as you're doing this planning. You know, you don't want to look at the best-selling one last year, or the best-selling one the 1 year before. You want to look for one that's going to be comparatively better than the other ones you're looking at. And that means that you want to sit down and not just look at one product. Maybe you want to look at 2 or 3 different products and put them side by side, because there's products out there today that are getting you 75% of the S&P 500's returns, while there's other ones that are giving you 50% of the market's returns. You know, I think that's a very important thing. You know, if we get 50% of the market's returns, we're probably going to consistently return about 3 to 6% a year without any downside risk. We get 75% of the returns of the market, it's only going to get better. But I want to know why the person is telling me this is the one that I should be using. Do they just work for that company?
Yeah.
Or are they independent and actually providing me multiple solutions and proving to me by educating me that this is the best decision and this is the best way for me to move forward?
And I think one of the important things to do is sit down with the person who has your best interest at heart. And that's where I'm hoping you'll be one of the next 10 people to pick up the phone and call Howard Bailey Financial. You'll be able to sit down for a complimentary review of what's going on in your portfolio, an independent analysis showing you what kind of fees and expenses are you paying, what type of taxes might you be able to avoid, and are you structured for that long-term income that all of us are looking for that we can't outlive in retirement. So be one of the next 10 callers and make an appointment to sit down with Casey or another member of the Howard Bailey team and put yourself on the path toward a purpose-based retirement. You can get started by visiting howardbailey.com. If you're not sure of the phone number on your screen, you can always look it up online, howardbailey.com, and we hope that we'll see you next week.